G'day, and we're live. I'm Scotty North. This is Zenium Live, and it is a Thursday afternoon. So grab a cuppa and a cookie and join us for some decent chatting about current topics. And today's topic is the king dead. Yeah, we're going to talk about the US dollar, the devaluation of the US dollar, and what that actually means for you. Being a Thursday and a fortnight, I am joined by the wonderful, the only Harvey Specter. Sorry, not Harvey Specter. We got PJ Patterson. PJ, how you going, mate?
I'm good. Scotty. Great to be here. I'm outside the tomb of a king. I'll just wait. Let's go this way. Tomb of the king there. Broadcasting. I'm not sure exactly where I am. I think I'm on some other ethereal plane. I'm not sure what king is in that tomb there, but it looks like something out of maybe Lord of the Rings or something. I'm not really sure, but I'll teleport back as soon as we're done.
All right. Well, mate, and did you especially, did you get your hair to match the backdrop or the backdrop to match your hair? What did you choose there?
I can't reveal my fashion secrets. I'll just have to leave you guessing on that one.
Well, you've got a fancy backdrop, so look what look what I'm wearing today. I'm wearing my bling gold
bling
chain, the dollar chain, mate. It's all gold, big dollar sign, because we're talking about US dollar. So I figured, right, I got to get into character and make it all happen.
So you're starting a rap group on the Sunny Coast. Is that it? What are you going to call yourself? The Sunny Coast Boys or something?
Oh yeah, maybe I don't know, the Dollar Dazzlers. Who knows? But all right. So in all seriousness, we've had a discussion offline about what's happening with the US dollar, and perhaps some of our viewers that either watching live or catching us on the Zenium Live podcast don't really have an idea what we're going to talk about. Now, in previous shows, we've talked about inflation and other bits and pieces, and now you're going to tell us about the devaluation of the US dollar. So I know you're going to let you do that, but my initial question is, what is the difference between inflation and devaluation of the US dollar? Is it one and the same, or is it two different things?
It's kind of one and the same. So as a currency is devalued, effectively, you then see price increases in your whatever country you're in. So the most obvious example of that is the US dollar devaluing and inflation kicking in the US, so the price of goods rising. Devaluation occurs, so there's a number of things to sort of cover off here. And as you pointed out a moment ago, we have discussed this in the conversation around gold and other things. But effectively, the way a country or a central bank devalues their currency is they print more of it. That's the only way to do it. They put more units of currency into circulation. And there's a number of mechanisms. We won't go into that today, but there's a number of mechanisms to do that. But effectively, they're putting more currency into circulation. And therefore, they're devaluing all the other currency units that are in circulation. It'd be like producing 100,000 cars, or let's say 100,000 Ferraris a year instead of 10,000 Ferraris a year. If you produced 100,000 Ferraris a year, the price of a Ferrari would drop because there's simply more of them in circulation. So the same concept applies to currency. And what happens then is that shows up in the price of things. So things like petrol and food and health insurance and any number of things will increase in. First of all, there's more currency units chasing those goods, and they also have to adjust to the fact that the currency has become more prevalent, and they go up in price to adjust for well, as I just said, the fact that there's more currency units around. So you have more currency units chasing the same amount of goods and services, so the price goes up. All
right. So as you touched on there, we talked about inflation. We talked about in previous episodes as well. But I know you're saying that the inflation and devaluation is one and the same thing. Like, they're printing more money, therefore the prices are going up, and the currency the value is going down. So there's your devaluation. My question is there a time when perhaps there's a reason to purposely devalue the currency? And are we seeing that now?
Yeah. Definitely. What you'll typically see is you'll have a currency war going on. And what countries try to do, of course, is they want to make their exports more competitive. So they want their trading partners to be able to buy more of their exports. And the best way to do that, of course, is to devalue your currency. So let's take a relationship like the US dollar versus the euro. So the Eurozone is a huge zone, a huge economic zone. The U.S. trades a lot with Europe, and let's think about maybe Volkswagens that are produced in Germany. So the German, when the euro is devalued against the U.S. dollar, because it means that American cars become more expensive relative to a German car. And so if someone's shopping for a car, they might go, well, instead of buying an American car, the German car is $5,000 less, so I'm going to buy that car instead. And that is because the US dollar would appreciate against the euro because they have depreciated it. And that was actually a dynamic that was occurring up until about a month and a half ago, where in actual fact, the US, it was the other way around, the US dollar was appreciating in value against most major currencies, including the Aussie, the euro, the yen, the pound, and now that has reversed because the U.S. central bank is trying to, or not trying to, they are printing literally trillions of dollars and putting that out into the system. So other currencies that are not doing that right now, or other countries that are not doing that, like the European zone, are finding that their currencies are appreciating in value, which means, again, that European goods will become more expensive to people in the U.S., and Europeans might then want to import more U.S. goods because they're cheaper.
Okay, so when a crisis like this happens, the US dollar is seen as a safe haven. So there's a run to it, and the run to it then means there's a hoarding effect, right? So there's less dollars in circulation, and therefore they're more in demand. Right, so the dollar sort of gets stronger, and we saw that earlier in the year. Right, we discussed that in a previous show. So now what I'm hearing you say is that that's happened. Are we seeing people selling the US dollar, or are we just seeing the absolute mammoth printing of new currency coming out from the Fed?
So what you're seeing right now is a recognition that effectively the policymakers in the U.S. are going to burn the currency, right? They're trying to devalue the currency, and it's obvious that they're trying to do that because interest rates have been slashed to zero. The U.S. Fed and the Treasury are buying all sorts of assets, and the deficit is growing. So there's just more and more currency in circulation. So it's just very obvious that the U.S. authorities are trying to devalue their currency. In fact, they've even said they want to devalue the currency. And so what happens typically, let's go back to the safe haven comment you make. What happens, and the reason I suppose that the US dollar has a quote unquote safe haven status is because the global the global economy, the wheels of the global economy are greased by the US dollar. So most major contracts, oil, commodities like wheat and corn and soybeans and so forth, and gold and silver, they're all priced in their local currencies, of course, but the trading contracts, the futures contracts, predominantly being traded in New York or Chicago on the mercantile exchanges, they're priced in US dollars. So in order for someone in a country other than the US, so Europe or Canada or Mexico or Australia, whatever, to trade in a good like copper is a great example. They have to buy or potentially sell a futures contract on the US exchange in US dollars. So this is typically when you see an event, which is a global event like a stock market crash or a pandemic or any of those sorts of things. What will happen is people will rush to the liquidity of the US dollar because it is the most liquid currency in the world. And they then typically once they're in US dollars, they will then buy securities like US treasuries because the US government debt market is the largest debt market in the world. So again, it's about liquidity and knowing that you're going to actually be able to get your capital back out of something. And that's why people go to the US dollar and then they go to treasuries or short-term T-bills or something along those lines. And that's why you have that safe haven status of the US dollar.
Okay, so that's if we see a devaluation happening because they're wanting more, getting it out there, liquid, all that sort of stuff you just talked about. What does that practically mean? I mean, does it first of all means that US exports are cheaper, therefore, yes, by definition, then imports are more expensive, right? So are they trying to get a more export footprint? Like, what's the reasoning and what's the real flow-on effect for us?
Okay, so if you are living in the US and you are paid in US dollars, it means for that person, it means your purchasing power has declined and your cost of living has gone up. It's a double whammy, and it's the insidious inflation tax that causes that to occur. So as a U.S. resident, you're getting screwed big time. Like, this is the Main Street, the non 1%ers are getting absolutely hosed, and that would happen in any country where the currency is being devalued and the cost of imports and things like that are going up. It happened in Australia when the dollar went from let's say, I think the dollar normally trades somewhere in that sort of 70 to 80, 85 cent range to the US dollar. But of course, we got down to the very low 60s, and I think we might have even touched into the 57, 58 cents. So what that meant is that for Australians, it meant that going overseas got very expensive, because it got expensive to go to the US, it got expensive to buy and import stuff from China, from the US, from Europe. And now that has reversed. So the Aussie dollar has gotten a bit stronger. It's around 71, 72 US cents, give or take, to the US dollar. So it means our purchasing power has improved. But effectively what it means for the local resident of that country is, if the currency is being devalued, it means you are losing purchasing power, and likely what's happening is inflation is showing up in, as I mentioned earlier, in the things like food and fuel and other rents and things like that, because the markets have that natural adjustment mechanism. So for you and me, it means the cost of living goes up.
Okay, so even though the cost of within your country hasn't necessarily changed, it's just more expensive to buy things from overseas, but that's a flow-on effect, is that we sometimes bits of a computer might come from here, there, and everywhere, even if it's assembled locally, right? So the actual cost of things starts rising.
It does, and you have to look at what a country's import-export footprint is. So a country like Australia, we export a lot of raw material. So a great example is, and I've heard this one before, we sell iron ore at, say, $100 a ton, and we import it back as a finished car for $20,000 a ton, right? That's the way Australia is set up. Now, we used to have a local car manufacturing industry, of course, but because of high labor costs and a number of other reasons, we sort of lost that. And so what it now means is we have to go overseas to get certain things that we require for our country. Luckily, we have a really strong agricultural base, so we can produce a lot of our own food, which is great. So we're not going to see necessarily a big food price inflation. But things like cars, when the Aussie dollar drops, things like cars, petrol, I suppose things like solar panel stuff that we don't make locally, all of those things get more expensive. So just think of it this way: anything a country has to import to function, if your currency is appreciating, so going up, that stuff gets cheaper. If your currency is depreciating or going down, that stuff gets more expensive.
Yeah, okay. All right. So, I mean, that's a never-ending cycle. I mean, if the devaluation is happening, then everything, I mean, we're talking about all your agricultural products, your fuels and oils, finished products, everything becomes more expensive. So will we see that flow on to, wages for the US? And I mean, this is all part of their own little maxi economy, right? I mean,
yeah.
There's always going to be, to me, when I see these things happen, there's always a loser, right? It's fine to say that everything costs more so everyone can get paid more, but that simply just doesn't happen, right? There's always seem to be losers in this.
it doesn't happen. And one of the biggest problems with wage growth is it happens very slowly. And the reason for that, if you think about the dynamics of this, so how do we get wage growth? Well, corporations have to earn more profit and earn more in order to give you a pay rise. So if companies cannot earn more because their input costs are higher, then they can't pass on a wage increase. So it's kind of a vicious cycle where you get into these periods of, and this is why central banks and countries are so fearful of things like inflation, because it can spiral out of control and you can enter a hyperinflationary environment or even just a real serious inflationary environment that basically destroys the middle and lower class. The upper class can typically survive it, but the middle and lower class get decimated because more and more of their pay packets go to just basic living expenses like food and fuel and shelter and housing. And the flip side to that, of course, is if your currency is too strong, then sometimes it hinders that country, because then your export and manufacturing export businesses and sectors then are not competitive overseas. So then your gross domestic product falls because you're not selling, as much, you're not exporting as much stuff. So there's always that fine balance. What they are always trying to do is find a balance of having interest rates set at, sort of whatever normal is now. I don't know what that is anymore. The interest rate policy used to be, for Australia, about 5%. Somewhere between 5 and 6% was sort of the normal policy setting. Now we're at 2 to 2.5%, for a home loan. So it's just madness to understand what is actually now normal in any policy setting. But anyway, that's what they're trying to get to, is that Goldilocks where you have growth going up, so GDP is rising. Inflation is, maybe going up a little bit, but benign, maybe 1%, 2% a year, something like that. So growth going up, inflation steady, and interest rates also are at a steady setting and not going up a lot, not going down, just right, like Goldilocks. That's what every central banker, central planner, and government is aiming for, is a Goldilocks economy.
Right. Okay. Well, the problem with Goldilocks is that there was some trouble in the woods, mate.
There's bears involved.
A few bears. Yeah.
Yeah.
Now, I don't know how well you can see this. I think I've made it as big as I can on the screen, but this is a chart I found, which is the rise and fall of the US dollar. There's not much rising there. It's mainly falling from purchase power from 1913, which is when the Fed is created. Correct. So now the peak sections here are recession periods, just in case you're wondering.
Okay. I've seen a chart like this before, and the interesting thing about this, and actually you could probably overlay any currency for that matter against a chart like this. The purchasing power of the US dollar has fallen ever since the creation of the Fed. Now, obviously there are periods there, looks like around the 30s and 40s, where the purchasing power of the dollar went up. But effectively what that chart will tell you, if I could read it clearly, it's basically saying that the basket of goods of $100 back in 1913 is now probably worth about, I don't know, about 5 cents, 15 cents or something like that. So
it's not interactive. I don't think it gives me a figure, but gee whiz, it would be barely above $2.
Well, let's even say it was $1. Let's be generous and say, I know it isn't, but let's say it was $1. It basically means that it costs you, $1,000 today to buy what cost $100 in 1913, and that metric's probably wrong. Actually, it's probably 10,000. But in any case, it just shows you how the currency has devalued over time. And people, they don't really understand this, because the metric that they're using, of course, is their local currency, and they think, well, over time, things appreciate in value. My house has gone up in value. My wages have gone up, in my yearly amount that I'm getting paid. But the best situation that you and I could ever be in is a deflation. That's where purchasing power goes up. But central banks don't like that, because it makes, and this is a whole nother thing, right? It makes the value of debt increase. So that's why they want inflation, because they can print money, they can pay off debt with newly printed dollars. That's why they want inflation, That's why deflation is bad for governments and central banks, but it's great for you and me because it means we can buy more with what we have. And so it's actually better to be in a deflationary environment. There's whole studies on this where there's been periods of history where there's been deflations or very, very little or no inflation. And in actual fact, the world has flourished. You could argue that we've had some great economic times over the last, 50 to 60 to 70 years. But, there's a school of thought out there that we're on borrowed time. And that's because we have now this mountains of debt out there, which is basically we bought and paid for this with debt.
So you touch on, we want to talk about some commodities here and oil, there's an oil crisis and second oil crisis. So are we seeing these things get more expensive or cheaper? These, this every day to day, I know that, I guess it kind of does my head in that you can buy a loaf of bread for $1.50, right? When I go to, I bought this thing today, right, at the cheap shop.
Yep.
This little dollar sign chain around my neck was like $4.95.
Yep.
Right. And I kind of go, but I can get a loaf of bread for $1.50. Firstly, in my head, it goes, well, how good is the loaf of bread? And secondly, how is that possible? I mean, where are the things getting pushed down to that this piece of junk cost me $5, but a loaf of bread is $2? Like, how does that work?
Well, I mean, look, it's there's a lot of cost pressures and stuff that get pushed down in terms of that loaf of bread. So I suppose you'd have to know, for example, did they bake that, like, I don't know where you shop. Let's say you're at shop at Kohl's. Did they bake that on site? And because they baked it on site, they don't have the transport costs, they don't have all the other stuff involved in delivering a loaf of bread. That's why they can sell it to you for $1.50. Maybe the maker of the loaf of bread was having a special at that point. Who knows? I certainly haven't paid $1.50 for a loaf of bread. I don't think, well, in recent memory. Of course, I don't do the shopping very often, but sometimes I do have to go get bread. I'm usually paying $5 or $6 a loaf. Now we get a little bit nicer bread than normal, but certainly the cost of those things is largely driven by a couple of key factors. Number one, how much is the commodity? Like, what is the cost of the base ingredients that go into that, making that thing? One of the biggest costs of any good that you buy or that you can purchase, one of the biggest costs is the transportation cost, the fuel cost. So if fuel is expensive, that's a big input cost into transporting that bread from the bakery to distribute to all of the shops, transporting the milk from the dairy farmer to the shop. So when oil prices go up, I mean, this is a great measure, right? When oil prices go up, I think the average person on the street knows that things are going to get more expensive because the price of one of the biggest inputs to running the modern global economy has just risen. But you could say that about any commodity. If you think about something like wheat or corn, if you have, for example, actually I use orange juice because this is a better example. We have these things called hurricanes that sweep through Florida. Florida is one of the biggest producers of orange juice. So is California because they grow oranges there, obviously. And so when you have something like a weather event, it could be a hurricane or it could be even an early frost, right? A cold snap, and it damages or kills, a crop. That can drive the price of something higher. It has nothing to do with the amount of currency in the system, but it has to do with the amount of the supply, I should say, of that good. If the supply all of a sudden shrinks of that good, it goes up in price. And that isn't related to the currency being printed as such. Obviously, that's a supply-demand feature, but it plays into it.
So on that note, I mean, you make a point about oil, right? So if oil's priced in US dollars and the US dollar is being devalued, then are we going to see oil price increase even if our purchasing power of the Australian dollar is increasing against the US dollar? Like, how does that play out?
Yes, you nailed it. So what you would see is the price of oil in US dollars would absolutely rise, and it is rising now as we speak. But at the same time, you should also see the Australian dollar rising, and so there should be an offset there, whereby you'll get a little bit of cushion, I guess, because our currency or the Australian dollar would be rising against the US dollar. But sometimes a commodity can run, much faster in terms of price increase because of other events. Great example of that would have been the Gulf War, one of the wars in the Middle East. Anytime a bomb goes off anywhere over there, oil price spikes because they think that unrest and a war over there is going to disrupt supply. So again, there's several factors in all of this. The biggest one is probably the currency and its appreciation or depreciation against other currencies. But the second factor would be, especially when it comes to commodities, would be the supply of it being affected by some other external event, a war, a weather event, something of that nature.
Okay, right. All right. So in practical terms, when it's this sort of scale, there's nothing really that we can do, right, other than try and be economical with our spending. I mean, we don't have any control over the US dollar or how things are priced or what.
Scotty. There's a lot you can do. And one of the key things that you can do to protect yourself. So I think ultimately the question you're asking me is, how do you protect yourself? Yes? That's what you want to know? How do you protect it? Yeah, okay. So you need to buy things that are naturally, and own things, I should say, that are natural hedges against inflation. Now, you and I are in the business of some of those things. Property is a fantastic hedge against inflation. The problem is when property has got debt on it, that can sometimes be a problem. But if you had unencumbered property, so your house, for example, it is going to be a natural hedge against inflation. Great example of this is countries like, I'll use an example, Venezuela. They had hyperinflation, have had it over the years many times. Argentina, same sort of example. People that owned property in those countries weren't affected at all because the price of the property just adjusted naturally to the inflation of the currency. So property is a great thing to own. We talked about gold and silver to a lesser degree as well. Great hedges against inflation have been since time immemorial. Again, you could own some of that stuff. Anything that is related to even the stock market, that's a most securities, not bonds. So anything fixed income are not, but anything like an equity, so just a normal company stock, typically is going to also have a natural inflation mechanism built into it. Because again, companies that are out operating, if we have inflation and currency devaluation, they're going to have to adjust their prices, which means that they will charge more for their good or service, and then hopefully they will maintain their revenues and things like that. So there's a few of the I'm oversimplifying that, of course, but that's effectively some of the things that you can do to protect yourself against the ravages of a devaluing currency and inflation. Oh, and the final thing is, of course, you can own assets in other countries. So even on our local stock exchange here, you can own a European equity ETF. You can own emerging markets. So great example of this is when the US dollar starts to devalue, that's actually the time when you want to start buying emerging markets, because they start to adjust to that and they start to do very well because of a dollar that's declining. So anyway, there's plenty of ways to protect yourself.
Right. Okay. That's good. So, I mean, you must have listed, a numerous number of ways there, and property was the headline. A core part of that is your own home, right? I mean, having that what we call that, the anchor, the cornerstone of your wealth should be your own home in the market. Not looking at it from an investment perspective, but it definitely would look at it from an inflationary hedge and a wealth protection perspective. Big time.
It absolutely is. And, we talked about this offline, this whole thing about, renting versus buying. And I mean, renting's fine. If you rent and that's the way you want to go, fine. You just must buy other assets. You must own some other property assets. You must own all the other stuff I mentioned. But I think the easiest one to do, and as you just said, make it that anchor asset. It needs to be a core asset holding, is your principal place of residence. There's a whole bunch of other reasons to own it as well in Australia. The biggest one is the CGT-free status of it. But certainly that thing will be a hedge against inflation. And all you got to do to know that is know that we've had significant property price appreciation over the last 20 to 25 years in Australia. And why do you think that is? Because they've been printing the currency, right? So this is why assets go up in value because there's more currency units chasing them, right? So that people they just don't get that dynamic. They just think, there are some supply and demand things, and of course we have immigration and all that stuff, but ultimately there's a lot of debt being created, a lot of currency being created, and so that's what drives asset prices.
All right. Well, we've hit our time limit. So my last question to you is the king dead?
Well, the king is certainly going to be in a coma for a little while. The dollar, of course, everything cycles, and so at the moment, yes, the dollar is going to continue to slide. That is what the stated goal of the U.S. government and the Fed is. They want to devalue the dollar. They want to torch the purchasing power of the people. And so for the foreseeable future, absolutely, the dollar is going to continue to fall. So that means that we should continue to see the Australian dollar rising. We should continue to see the euro and yen and pound and so forth rising against the dollar. And then if you really want to start to, bake your noodles, start thinking about all the other cross currency rates, like the Aussie to the euro and the Aussie to the pound and the Aussie to the, Singapore dollar, all this stuff, right? But anyway, just the basic relationships, the biggies are, U.S. versus the pound, the yen, the Swiss, and the euro. So for the foreseeable future, yes, the dollar is going to be under a lot of pressure.
Yeah. All right. Well, there you have it. PJ, thank you very much for joining us today, and we'll see you in a couple of weeks for a market update. We must be due for an August market update.
Yep, we will have a market update in August, and perhaps by late August, I suppose. And by then, we'll start to see, whether some of these resurgences of COVID are going to have any big impact, and of course, all the programs that have been put in place over the last few months are going to start rolling off. So we may have some really interesting things to talk about in that update. I'll look forward to it.
Yeah, no, I look forward to it as well. And look, thank you for everyone who emails in or comments on our page with ideas and topics and questions. We try and answer offline, and we prefer to answer as many as we can, including some online. And so thanks for always hitting us up about that. PJ, thank you. PJ Patterson from Keystone Financial Services is being our special guest today. And this is Xenium Live. I'm Scotty North. And until next time,